Welcome to the final lesson in our AFS course. I think it's significant that we are ending with a focus on cash because ultimately it is cash that repays debt. And so in this lesson, we are looking at the concept of global cash flow, a concept that was founded by the banking industry, and quite frankly, we lost our way and started to focus on asset appreciation until in 2008 when we had the market crash, and then we rediscovered cash flow and started to focus not just on the cash flow of the business, but combining it with the cash flow of the owners slash guarantors of that business. And so the primary goal of the global cash flow is to determine the borrower's ability to generate adequate cash flow to service debt. One would say more than just service the debt, which would focus on interest payment, but also to pay principal. And you want to be able to pay not just existing debt, but also new debt. One of the things that you should also bear in mind is that the global cash flow should not just focus on servicing existing and or new debt, but there should be sufficient cash flow remaining in order to continue to grow the business. So you would need cash flow to fund working capital, capital expenditures, for example. And so all of those factors should be considered as you focus on the computation and interpretation of global cash flow. Let us start with a general model for global cash flow. As I said, it's comprised of the business cash flow as well as the personal cash flow of the guarantors, owners of the business. And you should also note that global cash flow is relevant only for small businesses that are S corporations, partnerships, limited liability entities. It would not be relevant in the case of a publicly held company. And so bear that in mind as you go through your reading of the topic of global cash flow. On the business side, we are looking at the net income or loss of the business. This could be derived either from the financial statements or from the tax returns, Form 1120S, for example. So we start with the net income and we adjust that accrual-based net income to arrive at cash income. And so we add back things like depreciation, amortization, or, and this would most likely be found on the tax returns, any loss carry forward that the firm used. Based on tax law, you can take losses from a previous year and bring it forward to, let's say, the current year to reduce your profit for that year so that your taxable income for the business would be less. And so if that were to be reported, it's a non-cash item, and so you would want to add it back to arrive at the cash. And then, of course, you add back the interest expense that would have been deducted from the net income and subtract dividends and or distributions that would have been made to the owners of that business. So that's the business cash flow. And then on the personal side, we start with essentially their primary source of income, which would be salary. We are going to adjust that for interest and or dividend income. For example, they could have taken their distributions, invested it on a personal basis, and generate interest income, or it could have been their own funds that they invested, and so the interest and or dividend income would be added to their salary. Then you would also include any rental cash flow. So if they have rental property, or it could be that they own the business property and they leased that to the business. And so that rental income would flow to the business, to the individual, which brings me to an important point. If that were the case, then you would want to be sure that you're not double counting, because that rental income would be an expense on the income statement. We will then add cash distributions from Schedule K1 for S corporations, LLC partnerships. That would be an item that you would obtain there. And of course, you would subtract any contributions from that same schedule. And then again, remember, this is a basic model. And so you would take the sum of all of these numbers and multiply by 40%, which means that we are suggesting that taxes and personal expenses would account for roughly 60% of the personal income. Just a quick note regarding when the global cash flow should be used, other than when you have subchapter S or limited liability companies or partnerships. As far as using it within the bank, you would want to be using it as part of your loan underwriting, which is the focus for this particular lesson. But also it would be or should be part of your loan review at some point subsequent to a loan having been approved. And therefore, you want to be sure that you are using a consistent methodology. It would be best if bank-wide there was a consistent methodology. However, if you have no control over the policy of the bank, then at least make sure that within your portfolio you are applying the global cash flow on a consistent basis. So use the same approach for each of your customers. Recall from your reading of your text that there is no uniform format for the global cash flow. So once you have decided on a format, be sure to apply it consistently. This is an adaptation of the illustration in the chapter 15 of your textbook. You will notice that on the personal cash flow, these numbers were taken from the 1040 of the individual. And so you have your gross personal cash flow, which is primarily the wages, and then you adjust it or add to it any personal cash flow, for example, dividend income, interest income, and things like the sale of capital assets. For example, if you have investments that were sold, then you would want to include that as well. One important point here regarding the loss, for example, on the sale of an asset, we would include the cash from that sale and not the loss. So for example, if you have an asset that was on the books for $10,000 and you sold it for $8,000, that's a $2,000 loss. You would not use the $2,000 in the personal cash flow computation. Instead, you would use the proceeds from the sale, which would be the $8,000. Similarly, if you have an asset that is worth $10,000 and you sold it for $12,000, you would report the gain of $2,000 on your tax returns, but the proceeds of $12,000 would appear on your cash flow calculation. So be aware of that as you're going through the information in the text, as well as using this in the work environment. And so here we have our gross personal cash flow. Notice that this is very close to the number on the tax returns that is reported as your adjusted gross income. So as a quick calculation, you could use your adjusted gross income, subtract your standard deductions plus living expenses, or your itemized deductions plus living expenses, to get to the net personal cash flow available for debt service. So in this case, we have our gross. We subtracted the itemized deductions that were reported on the tax returns, and then we included an additional amount for living expenses. And so here you could have used the 40%. In this case, you would take 60% of this number, and that would give you your net cash flow available for debt service from the personal side. If you have the details, as in this particular problem, then of course use the details. But even here, they had to estimate living expenses because that would not appear on the tax returns. Remember, the itemized deductions do not represent all of the expenses. Those are simply the ones that are allowed to be reported as deductions on the tax return. So then we come to this final adjustment here, and this is a loan that was made by the principals to the business, and so it gets added in. And then we get to the business side, again from the illustration in the chapter. You can see that the business had a loss, and then we added back the interest expense. We also added back the non-cash items, the depreciation, amortization, etc., and we ended up with a negative number here. So basically, this business cannot cover any of its debt, service any of its debt, because this is negative. However, because we are including the personal cash flow, we end up with a gross cash flow of $84,448. So that number is used to compare against the debt service requirements. So we have personal debt service of $52,200. We have business debt service right now of $14,000. So that's your total debt service. And in your computation of the debt service, try to be as conservative as possible. So for example, if let's say this loan to the business is worded as or structured as interest only, I would impute or compute a principal repayment as part of the debt service requirement, because you want to get to a number that is as conservative as possible, as reliable as possible. And here in this example, the debt service coverage ratio is 1.28, which is taking the global cash flow of $84,448 and dividing it by the debt service, the global debt service of $66,200. So we have 1.28. Ballpark, a good debt service coverage ratio is 1.25. And so we would say that this, of course, exceeds that standard number. However, you would not want to just necessarily go with the number that you computed as your most recent. Instead, the gold standard is for you to use an average of, let's say, 4 years of debt service coverage ratios. Or you would use a weighted average of, let's say, the last 4 or 5 years. Weighted as in a percentage from the personal and a percentage from the business. So you would decide if the weight should be more heavily placed on the personal or more heavily placed on the business. Again, think conservative when you are doing these kinds of calculations. The deviation from these two recommendations would be if this is the lowest debt service coverage ratio that you have computed to date, then you would want to go with that particular number. But generally speaking, I would recommend an average debt service coverage ratio. So take the debt service coverage ratios from previous years, add them, divide by the number of years, and you get an average, or you can do a weighted average. I just want to quickly share with you where that $46,000 loan came from. This is the personal financial statement of the principals of the organization. And you can see here that the year before there was zero, and then it went up by $46,000. So that's an increase in asset. That's a use of funds. So for the individual, it would be a use of funds, but for the business, it would be a source of funds. And so this would get added in as funding. The other thing that I should have mentioned that I didn't is that when you are including items in your personal cash flow computation or your business cash flow computation, question whether those items are sustainable. Are they going to be every year, or is it one time event? For example, if they sell their investments and they generate cash flow from that, is this going to be done each year? If the answer is no, then exclude those items or that item from your computation of the cash flow. I want to end with recognition that the global cash flow preparation can be challenging, not just in terms of obtaining the needed information, but also in terms of using that information. And so for some people, it will be daunting to go through 1040s, 1120s, Schedule 1, 2, 3, Schedule ABC, Schedule K1. It's just a plethora, it seems, of forms that are there. But if you just bear that basic model in mind, it should prove to be less challenging or less daunting. And so one of the things you want to be aware of is that it's difficult to combine personal and business income. What would you do, for example, if you are looking at the personal tax returns for a couple, but only one of those two individuals is a guarantor on the loan or is a principal in the corporation? Well, conservatism would suggest that you would want to exclude the income of the individual who is not a guarantor and or principal of the business. Alternatively, you would want to see if you can get that other person to be a guarantor willingly on the loan. Then, of course, there is the issue of incomplete information, where you may have tax returns, but all the schedules are not available. Of course, in the United States, you can obtain permission to request tax documents from the Internal Revenue Service, but again, the challenge is there that you may be working with incomplete information, not just for calculation of cash flow, but just for your general analysis. And then the other thing that I find that people run into problems with is double counting. where you count something on the personal side and then you count it again on the business side. So be sure that you are not doing that. And also, as I said earlier, you want to be sure that you are using the cash from a transaction and not the profit or loss. So if you have an investment that was sold, you want to use the proceeds, not the gain or loss from that calculation. I do wish you all the best with this important concept, and know that you can always reach out to me for assistance if that is the case.